Welcome, everyone, to Noble Capital Markets Basic Industries Virtual Equity Conference, and thank you for joining us today. I am Mark Reichman, a Senior Research Analyst at Noble. It is my pleasure to introduce Mr. John Batten, President and Chief Executive Officer and a Director, and Jeff Knutson, Vice President of Finance, Chief Financial Officer, Treasurer, and Secretary of Twin Disc Incorporated. Twin Disc, headquartered in Wisconsin, is an international manufacturer and worldwide distributor of heavy-duty off-highway and marine-powered transmission equipment and related products. The company's shares trade on the NASDAQ under the symbol TWIN. Welcome, John and Jeff.
Thank you, Mark. My name is Jeff and John, and we'll walk you through a little bit of the background of Twin Disc, starting with the normal safe harbor discussion. I'll leave that ceremonially for a second, but focusing on initially what the investment highlights as we see them for Twin Disc. Really five, I think, unique things in regards to the company and the timing. We're in a position where our backlog is historically strong, and we have healthy demand across all of our product groups. Our technology, innovative technology, continues to gain traction in our niche markets, in particular in the marine and industrial markets. We have been executing on our strategic playbook to increase margin and increase cash flow generation, which has allowed us to take some strategic actions. For example, the Katsa acquisition just recently. We have accelerating growth through our end markets, both in industrial and marine technology M&A opportunities as we look forward. And where we are strong, our niche capabilities in product groups that allow us to really capitalize on our global reach and our technology. So a brief overview of the company. Twin Disc is over 100 years old, 106 years old, headquartered today in Milwaukee, Wisconsin, with about 800 employees worldwide. Revenue last year of just under $300 million, and EBITDA margin at about 9%. A relatively healthy mix of revenue, both by product and geography, well balanced between land-based and water-based applications and geography. Europe is actually now our strongest market. Most of our revenue, 33%, or the biggest piece of our revenue going into Europe, and then evenly split between North America and Asia Pacific. With that, I'll turn it over to John for some historical looks.
Yeah, just looking back at our 106 years of history, really the first 80 years were fairly organic growth and some product line acquisitions in the early 90s. And it really wasn't until 1999 that we started into some acquisitions of some companies in Europe, 3 companies in Europe, Technodrive, BCS, and Rolla. Then we really didn't do many acquisitions for about the next 15 years. But in 2018, we did our largest acquisition ever, Veth Propulsion, out of the Netherlands, 100% marine-focused company. And then just this year, we did our second largest acquisition, Katsa Oy in Finland. Asset-heavy, excellent producer of gears and gearboxes. Both Katsa and Veth had a very strong Europe-focused only customer base. We've done an excellent job taking Veth out to the rest of the world, and we're anticipating doing that with Katsa as well as we go into fiscal 25 and beyond. So when you look at our product groups, we separate ourselves into marine and propulsion systems and land-based. And in the land-based ones, we have our vehicular transmissions and pressure pumping transmissions in our industrial products. And in marine, we have our marine transmissions, our azimuth thrusters that we produce in the Netherlands and Veth. We have our Arneson surface drives and roller propellers, and then the controls that go with it. So they each have unique channels to market, whether it's distribution or OEM focused. But all of these products, as you'll see coming up on the next slide, are transitioning from traditional internal combustion engines into both hybrid and fully electronic projects. So it's very exciting. It's the first time in our history where everything is being rethought in the off-highway markets, which also includes marine. but we have substantial business in each one of these areas. And there are active projects going on for either fully electric or fully hybrid applications. Taking a moment to look at our strategy, just following on with that hybrid and electric, it is our mission to become the leading supplier of hybrid and electric solutions in our markets, off-highway and marine. We've had a lot of successes more early on in the marine area, where it is a smaller market in terms of the number of participants, the number of markets, the number of players. And around the world, in the global market, we are recognized in the leader in marine transmission and propulsion technology. So we've had a lot more wins there first. It's been easier to work with some customers and get things going. But we have projects going on in our transmission business, as well as our industrial business, to expand into that hybrid and electric space. As I mentioned with Veth Propulsion, when we acquired them, they were almost 100% European focused, and now we've had some great growth in the Asia Pacific markets and in North America, and we helped introduce them to a new market in Europe, the mega yacht market, where that's currently probably, as far as backlog goes, their second largest market as of right now. With acquiring Veth and Katsa, we have new footprints, and we've been rethinking all of our global footprint for efficiency and customer response. Veth's growth has allowed us to use up some vacant space both in North America and Asia and Europe as we retool plants to help with that product's growth. We also have on the bottom there, whether it's hybridization, electrification, we started out being known for our clutch capability, whether it was in a PTO or transmission. It soon became apparent that our ability with our electronic controls and design of that, the control of clutch, that's now what we're known for, our controls technology, whether it's in marine, transmission, or industrial. So even if applications aren't going electric or hybrid, they're absolutely moving into systems where everyone wants the fewer number of suppliers, the better. And they're looking for us to bundle products and sell those as one package to the customer. And then again, the focus has been in the last 5 to 6 years, balanced with some strong push for organic growth. We've been much more active in the M&A space with both Veth and Katsa, and have active projects to continue that growth in the very near future.
So in terms of our targets, it's something that we've started to do somewhat recently, is share where we think we're headed, where our medium-term targets are. We've actually increased our revenue target just recently following the acquisition of Katsa to $500 million of revenue by fiscal 2030. And we expect to achieve that through, as John said, becoming the hybrid and electric application leader in our markets, continue to expand the Veth product line around the world, focus on the growth of our industrial product line, which would include the Katsa integration of the Katsa business, and then likely further M&A in the next few years. With that, we would like to consistently deliver gross margins at or above 30%. It's been a focus of ours for some time. We've achieved 30% historically, and it's been typically a matter of mix within our volumes. But as we go forward, we're looking at rationalizing some of our European cost structure, driving further operational efficiencies, and trying to maximize margin coming through that hybrid electric channel, which will be more of a more pass-through content than typically we would have in our normal base business. And while we're delivering that additional revenue, gross margin, continuing to deliver free cash flow at 60% of EBITDA. That's how we look at it. It's a conversion of 60% free cash flow of EBITDA. And it's something that we've done very well recently. The last, say, 18 months have been essentially record levels of cash flow for the company. I think we still have a nice runway ahead of us in terms of the ability to generate cash. Focus heavily right now on our supply chain processes, rationalizing our manufacturing footprint, and really being smart about what we do with our capital dollars. And I think that's the last slide. So we'll open it now for questions.
Thank you, John and Jeff. So I guess I'd lead off by asking, how does Twin Disc differentiate itself from competitors?
So I'll take this one. It's John. I think the number one way we differentiate ourselves from our competitors really is in a couple areas. One is our controls technology, which I mentioned in the presentation, the ability to control the input speed into our product and the output speed. And with that, not just the speed, but the torque. We've got over 100 years of taking horsepower, turning it into torque from a prime mover, mostly been a diesel engine. But with our controls technology, we can take either one input or two inputs, so a diesel engine or internal combustion engine and an electric motor, and still control the output and make the application as efficient as possible, whether it's in a vessel or a military vehicle, farm tractor, or piece of construction equipment. And then I think what sets us apart for a company our size and our niche markets is the support after the fact. After it's been delivered and the piece of equipment goes anywhere in the world, I really would put our support, our distribution and dealer network around the world is second to none. About the only other one that I think is comparable in our markets would be Caterpillar, who sets the bar very high. But we're in every major country, every major marine market, every major industrial market. We're there to take care of our product and our customer products after it's been delivered. So those are I think the two things: our technical capability, our ability to use that in creating a good application for our customer, and then taking care of it after it's in the field.
Now, what do you see as the main drivers of growth that will propel you to meet your medium-term goals?
So two things. One is as more and more of our customers turn to hybrid or electric, there's just no secret that the cost of the piece of equipment is getting more expensive. So for a traditional crane where we would sell a $25,000 pump drive or torque converter, we're now selling a $160,000 hybrid system to the same crane. Now the crane is more expensive, but we're getting a lot more content. So as we see the trend picking up of more cranes, more pieces of equipment going hybrid or electric, we're going to see our revenue tick up. That coupled with a concerted effort at M&A to add products and technology and geographies, I think that's what's going to accelerate our growth more than what we've experienced in the last 10 to 20 years.
Well, you mentioned you've had pretty strong results recently. So what do you think the company needs to do to sustain the profitability or even, increase margins?
Well, a couple of things. One, it's controlling our internal costs, and that means working very hard to bring down or control the costs, the input costs on material, finding competitive sources, whether they're in low-cost countries like India, Mexico, but continually challenging our cost basis, but then also not letting our MEA or SG&A costs grow linearly with our top line. If we do those two things, I think not only will our top line growth accelerate, but our margin growth will accelerate as well.
And so what are your capital allocation priorities over the near term?
Yeah, so I think it still remains M&A for me. I think we'll continue to support the dividend, at least at the current level. So after several years of a hiatus, we brought the dividend back last year, and
Right.
based on our strong cash flow performance and outlook. So we will continue to support that, continue to support capital spending on machine tools for efficiency, for volume, but really focusing on M&A that can deliver profitable growth and drive us to that 500 million revenue line. So it's things similar to the Katsa type of acquisition. And for us as a relatively conservative financial run company, we would never over lever, let's say. So we would always be looking at not going too far over a 3-to-1 leverage ratio and try and get back under 2-to-1 shortly after any action. So a lot will be driven by our ability to generate cash.
So speaking of acquisitions, I mean, what are you focused on in terms of, acquisitions in 2025? And maybe you could just elaborate on your investment criteria.
So I'll take the first part of that. So I think two areas jump out continually. One is if it's metal products, for our portfolio, I would still like to focus on industrial products. That's the area of our business. When I went over in the first slide, that's not $100 million business. Our marine market is, our propulsion market is getting close to that. Our transmission, on land transmission business is over 100 million. And so finding products that would get that industrial business up to an equal stature within the portfolio of 100 million, that would be one. Two would be any technology, controls technology, battery, something for the hybrid system that will go across all of our businesses, that we could leverage across all of them. That would be also a priority. So those two, metal products, actual components for industrial, or technologies, batteries, motors that would go across the whole portfolio would be the two things that I would stress from an actual product or type of company we look at.
Yeah, I guess I would just add that in terms of our criteria, from a financial perspective, we have a kind of a sweet spot in size. So we would be looking in the, say, $20 to $50 million range. We would be looking for something that's accretive to our EBITDA margin, so something north of 10% EBITDA, but probably more importantly, or at least as importantly as John said, something that fits into that strategic vision for the growth of the company and something that fits our culture. I think that's been really a strength of both the Veth acquisition and to this point anyway, the Katsa acquisition, just a very similar mindset around the quality of the product, the approach to serving customers. That's worked well for us.
I was just kind of curious, how do you source these acquisitions and the ones that you've done? Do you feel like you've got the process down pretty well in terms of integration and being able to realize the accretion pretty immediately?
So to the first part, the process, we've been very lucky in that almost every acquisition we've done has been based on a personal relationship with the company. Smaller, privately owned, sometimes one family, often two, and we've known them from just being in the same business for years. And as the current family member or the existing one is looking to exit the business, they knock on our door or give us a call or send us an email now. So we've been very lucky that we have not had to compete in the book, the bidding process. We've been involved in those. We've lost some. We've lost all of them. So we've been very lucky in that the companies that we've brought on board, we've known them. And more importantly, our employees have known each other. So it's been culturally very easy. There's no question that when after we acquired Veth in 2018, COVID certainly set us back a little bit on momentum of integrating, but we've seen the synergies take off from 2020 on as far as the growth in the backlog, the growth on their top line. And so we're just beginning that same thing with Katsa. We've known them for not as many years as we knew Veth or some other ones, but they were a supplier. And so we've been very deliberate in getting all parts of the organization together to find those synergies and begin to work together. So we're by no means expert on it, but I would just say that we've been very fortunate because every acquisition we've done, we've known the company, at least for a decade.
Well, so what are you most excited about heading into 2025?
So for me, it's a couple things. One, just where we are right now relative to some others. A lot of our markets and suppliers and competitors have been going through, I would say, a cycle that looks very recessionary, where their sales have gone backwards, backlogs are down, And we haven't seen that. And we have been, very fortunate with our conscientious shift away from oil and gas with the acquisition of Vet. That business has been growing. We acquired Katsa at the right time. Their backlog is growing. And some of the areas where we've seen some sluggishness, we've been able to push through that with other parts of the business growing. So you could say 5 or 6 years ago, certainly without Katsa, definitely without Vet, we would be very different. We'd be looking at a cycle that is in the downturn, but we haven't seen that. And the excitement is around having those new products from Katsa in Finland and Vet in the Netherlands, that we're poised again for another year of growth. Where in a different scenario, we'd be facing recession like many in our market.
Well, John and Jeff, thank you so much for joining us today.
Thank you.
Appreciate it. Thank you, Mark.
What's up? It is Damon John from ABC Shark Tank, the #1 shark in the tank. However, I'm going to be joined by my fellow sharks, Robert Herjavec, and not so wonderful, I'm just joking, Mr. Wonderful, for Noble Capital Markets 20th Emerging Growth Equity Conference on December 4th in Boca Raton, Florida. I can't wait to see you there. Peace.